So what are you doing to your portfolio to prepare for that?
Well, at this stage, we're not doing anything specific to the portfolio, but it's a factor that's on our radar screen as to thinking just in terms of what we think about particular companies and how they would cope with that sort of environment.
How have you done out of the capital raisings that have been announced, in particular the bank ones, but in general?
Yeah. Well, in fact, that's been mostly the area we've been active in. We haven't been all that active buying things on the market itself. I think if you look at the top 15 purchases that we put in our recent announcement, 14 of the top 15 were placements and new issues. So we've been keeping our powder dry for those as they come along, and we think there'll probably be more of them.
There's been a lot of criticism about the structure of those capital raisings, accelerated capital raisings. Do you share that view, or is this the optimum structure for this kind of environment?
I think we hold the view that to the extent that companies can, they should try and make sure all shareholders can participate. But we've been through an environment which is pretty unique, where if they hadn't got the equity quickly, quite dire consequences could have arisen in the market in terms of share price. And so I think there have been some companies that have had to go the accelerated route because it was just essential for their survival. And obviously in those environments, it's hard to quibble. But certainly we saw with the Rio transaction, that was a very good one in which there was plenty of participation by all of the shareholders, and even the ones that didn't participate actually got some benefit from the rights that were sold on their behalf. So our fundamental setting would be, yes, try and include all shareholders if you can, but if the alternative is severe trouble, then clearly you want the company to do what's best for the for the company as a whole.